dollar cost averaging, which is a very old idea. I mean, it's very old. I got in the industry in 1986, and it was one of the first things I was taught. It's a very old idea, but it has not lost its value, and I'm going to show you a little bit about that today to kind of help explain that. But what is dollar cost averaging if you've never heard of it before? It's an approach to purchasing investments in which the buyer spreads out their purchases so the total price paid is less affected by market timing. So that, for instance, if you buy in on day one and the share price is at $10 and you were putting $100, you'd buy 10 shares. If the next week it's up to $12, which wouldn't normally be that high, I'm just using this to give an illustration. If it's up to $12, you're not going to buy 10 shares, you're going to buy 8 shares. And if it's down to $8 a share, the following month, you're going to buy more shares, 12. And so what's going to happen is over time, you're going to average those purchases out so that you end up with hopefully a higher average. Now this, as you're about to see, only really works well in volatile markets. If you were to take, as you'll see in a moment, and invest a lump sum of money in a market where it's just going up, you'd be wiser to go ahead and invest the lump sum. But if you're investing in markets where it's volatile, you'll see that it's probably better for you to go ahead and buy in through a dollar cost averaging model. Now, the real issue is nobody knows. We think we know what's going to happen with the markets, but if you're concerned about volatility, then using dollar cost averaging or over a 12 to 18 month time frame can be a great way to help you minimize risk while getting advantage of those opportunities and gains. Now, what do I mean by that? Well, so I'm going to actually take you to this website and show you some examples of this, but what we're doing here in this is we're comparing $35,000 investment, one done as a lump sum and one done as a systematic investment. And what we're going to do here is in this one, and this is going into the SPY, SPY, which is the exchange traded fund for a SPDR with the S&P 500. So this is like buying into the S&P 500. And I started this, you can see it, it's January 22, and I ended it in February of 24. Now, over that period of time, I started on this one here, and I said, well, let's just put in $35,000 one time. And so over that $35,000, and if you look at how the S&P behaved, what you're going to find is it went down, and it did that in 22, and then it came back up in 23. And so what happened was, my cursor, there we are, we invested $35,000. Our $35,000 grew to $36,976, so it's about a $1,976 gain over that period of time. That's about 5.65%. Now again, I added nothing. I just put 35,000 in one time in this calculator. In the bottom chart, I put in 10,000 up front, and then I put $1,000 a month in over the same number of months, January of 22 to February of 24, which means I put in a total of $35,000 of investment. That same $35,000 of investment, by buying in at times when the market went down and buying more shares, and when it went back up, buying less shares, I ended up with an account value of $40,143. I had a $5,100 gain, and I had a 14.7% average annual return. And so dollar cost averaging is a way that if you're looking at some investments that you're thinking, oh, I think I would like to get in, but I'm really concerned about market volatility. You don't have to pull from your monthly money. We could take a part of your portfolio and set aside, and I'm not making this as a recommendation, I'm just using it as an example, but you could say, I want to take $50,000 and set it into an account, in a cash account, and then I want every month for that to move $2,500 over. So that on the months when the share price is higher, I buy fewer shares, and on the months when the share price is lower, I buy more shares. And then by the time we get to the period where that whole $25,000 or $50,000 is invested, we'll now see what the returns are. Now again, as you'll see in a moment, if the market went straight up, you're going to wish you had just put it all in early on. But if the market was volatile and had good and bad times, you're going to be more happy. You're going to be happier, I believe, because you will have seen that value work in that way. So let me go to that calculator and show you how that looks.